All right, good afternoon, traders. Welcome out to the Tradespoon Active Investor Workshop Series. I know my slides say different. So I actually even said this. I was just in a trading room and I said, for those of you who are coming back, so Dennis, Faust, good to see you guys. This 2020, man, this is a different kind of year. You know, everything's a little every other thing I see on Facebook now is a joke about 2020, right? So I'm extending that into this workshop. I've been going without slides, and I like it, and I'm going to keep it up. That's the theme. I'm going to keep the theme today. It's weekly versus monthly options. We'll talk about that. We'll talk about weekly versus monthly options. It's also an open forum. So if you have some questions, there'll be time to just kind of ask about anything, right? Just put it out there. These are learning aspects, right? We want to entice people to come and see what we have. We're going to look at the model. We're going to look at some things, some trades. I'm actually going to show a couple of trades that I considered and built today during the trade room as an example of looking at something weekly, right, versus monthly. Why would I choose one versus the other? What are the thought processes? Things like that. So I hope that's interesting, and go for there. What is my top number for NDX and SPX? Are you saying like a resistance? I'm not sure the question. When you say my top number, you mean like a forecast, or give me a little more information what you're looking for. Okay, so let's dive in. A little bit about me. I am, again, my name is Scott Beck. I have been trading for a little over 20 years. I've been teaching for a little over 16. I do need to remind you that trading options in particular can involve substantial risk, may not be suitable for all investors. Please read characteristics and risk of standardized options prior to investing in them. Evaluate any strategy prior to use to understand risk and suitability. You must be aware of the risk, be willing to accept them in order to trade in these markets. Tradespoon and myself are not investment advisors, not registered with the SEC or FINRA. Should not be assumed that future trade picks will be profitable or will equal past performance. The information in this presentation is provided solely for general education information purposes. Any strategies discussed, including examples using actual securities and price data, are strictly for illustrative and educational purposes. In order to simplify the math, commissions, fees, margin interest, and taxes have not been included in the examples used in this presentation. Those costs will impact the outcome of your results and should be considered. Lastly, I and/or the team at Tradespoon may have a financial interest in the securities presented and the trade picks. Okay. Weekly versus monthly. So a couple of things that we'll go into. I mean, really, when you're talking weekly versus monthly, you're talking time. So you're talking about how time may influence any particular strategy, where I might go short term versus longer term. Obviously, and I don't have slides. Like I said, we're gonna. If you're asking people, say, where's the slides? I don't have them. We can pull up something to look at just to have something for now. But we're gonna go look at actual trades to see the consideration. But there's a couple of things that I'm going to say when it pertains to weekly versus monthly. The first thing that I'm going to say, man, did you guys see how strong the market got right at the very, very end? Last 5 minutes, just buyers came flooding in here. Boom, smashed it up. Put on a couple trades. Okay, so weekly versus monthly. So let's go in and look at I'm not going to even use SPY. I'm going to use, well, let's use Facebook. We just built a trade on Facebook. Okay. So here's Facebook. First and foremost, whatever platform you're using, you're going to look to be able to quickly identify, first and foremost, whether or not they offer weekly options, right? So when I'm first assessing, if I run a scan, a search, I'm talking to somebody and they mention a symbol and I think, ooh, that looks pretty good, I'm going to go take a peek at that. I'm evaluating it for liquidity. If you've ever traded with me, watched me trade, come to a trading room, see me, I'm a liquidity snob with options, especially now in a time like this. Anytime there's higher volatility, and even now as we've come down, there's still elevated volatility. First and foremost, and I don't know the exact number, if anybody as a trivia question knows the exact number right now of stocks that trade weekly options. I'm curious if you know it or are a fast Googler and can find it. I would estimate around 450 stocks or so. And that right there, in my opinion, is a wonderful, wonderful filter. I would say there is only about a 10% probability that I would, maybe even less, 5%, 3 to 5% probability that I would be willing to trade a stock that doesn't offer weeklies, right? So when we talk about weeklies versus monthlies, for me as an options trader, the first and most important consideration is that choice available on every stock that I have in my watch list? Like I said, it would be very, very difficult. I'm sure there might be one or two right now that are, but it'd be very difficult at any given time for a stock that doesn't offer weeklies to be in my list, because that means it's not trading enough. It doesn't have enough volume and open interest to entice market makers to offer. If it trades enough, they're going to be like, yeah, let's offer weeklies. Let's give people more to trade so we can, the more the market makers trade, the more money they make, right? They're interested in that. That benefits them, it benefits us. So that first and foremost in the weekly versus monthly, use weekly as a filter. In fact, one of the things I like about the screening tools here at this platform, Thinkorswim, is it does allow you to actually screen just in stocks that offer weekly options. Nobody has the answer for the number of weekly options. Okay, it's a mystery. It's going to go unknown. We're all just going to have that little tidbit of knowledge that we desire but don't have floating around the back of our minds. Okay. Let's move on. So liquidity is as a general consideration. I want to make sure that I am. If I were to go through this list here, this is a little older. We've actually been working off a different list, but if I look at this list here, you're going to see every single stock has weekly options. And even then, we looked at building a trade on Adobe today, and it actually didn't have enough options to build the trade. And the two that we looked at, and here's what I'll tell you about weeklies. As much as they have, and you can see they're very, very much, that's it, 285? Albert said 285, 65 of which are ETF. Oh, 285 stocks, 65 ETFs. So what's that? A total of about 350? Okay. Oh, that's my world right there. 350, beautiful. Right? I think that's less. So it's come down. It used to be like 450. So that's good, because there were plenty in there that, even though they had weekly, still weren't that good. And that's what we're running into here, for example, with Adobe. I could certainly build a successful trade on Adobe, but if I have 5 or 6 stocks that I'm looking at to build the trade, and I get here, that's what actually happened. We had 5 or 6 that we were looking at, that we were interested in the trading room today. And this was one of them. And as I looked at it, I actually still came here and I still looked here. Why? Even though there are weekly options, and we're going to go through and talk about this, even though we have weekly options, let me now delete that. If you look at volume and open interest, so let's look at this week. You can see there's some pretty heavy volume here and there, 1,000 contracts right there around the money. The open interest is not high. Not a single one of these has 1,000 contracts, not one single contract. On this side, we barely have triple digits. And if you look at the spreads, there's a lot of width in there between bid and ask. That width between these two numbers is what you're paying market makers. Okay, so I was going to guess around 3,500 stocks trade options total, but it's actually closer to 4,000. Albert is today's trivia winner. I love that. I'm going to be talking about those stats. 350 trade weeklies, approximately 4,000 have options, which in my opinion means approximately 3,650 stocks are garbage options. So be careful out there. be careful. There's some garbage out there with some shady market makers looking to take your money. Check the open interest, check the spreads, check the volume, make sure there is an efficient market available to you. Yeah, that's my advice for today. If that's all you walk away from this with today, I promise you will be a better trader for it. So Adobe didn't have the right spreads. I thought, look, I would rather go put a bullish trade on in what was another one we were thinking about? I was even thinking about CRM today. Right, there were some bullish ones. We ended up putting trades on Alibaba and Facebook, also both in that same, kind of internet slash retail, etc. Speaking of Facebook, earlier today, here's a comment coming in. I did a September 11th broken wing butterfly. I like butterflies. I'm a butterfly kind of guy. Looks like buy the 295 buy, 310 sell, 325 buy. That looks like a regular butterfly. They look like they're 15 apart to me, no? Which was the broken wing? They look like they're 15 points to either side. I like it, but anyway. Okay, so back to the options. Let's go back to the options. Adobe. Yeah, no, balanced, but still looks good. Looks good. The weekly options versus the monthly options. So let's talk about a couple of things. Number one is time and time decay. So if you are looking for time decay, weekly options present great opportunities. When I do butterflies, and I will tell you right now, and I miss these days, those beautiful, beautiful days. I love calendar spreads. Calendar spreads are a theta positive strategy. That means I'm looking to make money from time. That works very well in a low implied volatility market. And when I say low, I mean like VIX at 12 low, maybe 15, but 12. I love a very, very low. In that type of market, calendar spreads are phenomenal strat. I love them. And I don't go far out, 2 weeks, 4 weeks usually. At any given time, 2 weeks, 4 weeks. So that's only possible with weekly options. I do butterfly spreads, usually 2 weeks out, sometimes 3 weeks out. Selling options. When you sell options, you want time to decay quickly as an option seller. So what the weeklies present is it presents some opportunities to sell short amounts of theta where it decays quickly. So when implied volatility is a little bit higher and you have good premiums, it's a phenomenal thing. Now, if you've come to the trading rooms that I work, sometimes I will buy options. If I have low implied volatility, which means options are cheap, I might do an all or nothing trade where I might buy an option that's 10 days out, a little out of the money, where I pay, 40 cents, 30 cents, 50 cents, and I buy as much as I can afford for my position size so that my risk is managed. So if I'm willing to risk 250 bucks and I buy a 50-cent option, I buy 5 of them. And I have 10 days. So if I catch the move I'm looking for, I might get 6 to 1, 7 to 1, 8 to 1. So there are a lot of very specific circumstances, right? The only way they'll be that cheap is if you're willing to kind of say, hey, look, I need 5 days for the move and 2 or 3 days for it to develop. And if I catch it, if I catch a piece of it, we had one the other day, we caught a piece. We ended up making a little bit of money, started to slow down. We took our profits and walked away. You have to manage a trade like that much more aggressively. When you're trading weeklies, you have to manage them much more aggressively than you would the monthlies. And that's where the monthlies come into play. So let me show you a trade that we actually built where we evaluated. Here's the Facebook trade that we built. Let's go look at it. Okay, so we put on October. This is the trade right here that we ended up putting on October. And this is the trade we considered in September. Same trade. Okay, same trade. Now this is a bull put spread. So this is a delta positive, it's bullish. Theta positive, it makes money from time. Vega negative, we want volatility to go down, which means if I want volatility to go down, my assumption would be volatility should be high. So if we look at the chart of Facebook, you can see where these parameters come from. I'm bullish because the trend is bullish, right? Because the trend is bullish because it consolidated and is now starting to move again. The model, as you'll see here on our Tradespoon forecast, shows up very bullish, favorable grade, top 25%. You can see it's got a very strong prediction. It's been pretty accurate here recently, so that looks good. We know there's a lot of momentum here, a lot of trend in our favor. All of this looks good. So we go forward, we build the trade. On this trade, I set some parameters. I said, I'm wrong if it turns and goes against me. Now, one of the tools that I like to use in conjunction with the model is Heikin-Ashi candles. So let me show you what that looks like. And right now I have candles that are accelerating, but I still actually put my stop loss 280. Where did I put my stop loss? Let me see. Hold on. 289.90. So I actually have a stop loss set back here. I'm looking for this to start accelerating again. So ideally, what I would like to see tomorrow would be something that looks like this, at which point I would move my stop from here up to here at the end of the day. That would take a good chunk of the risk out of the trade, and I'm looking for this thing to make another bullish move. Great, that's my trade. Okay, I'm working off of some assumptions from various technical analysis models that I use. Tradespoon model, I use these candles here. There's good confirmation between the two. With the stop 289.90. Yeah, thank you, Faust. Right down underneath this. So basically, what I'm saying is if this thing tomorrow, just out of the blue, turns around and just imagine this is a red candle, just is like, bam, to the downside, and it takes this out, I'll be like, okay, I'm wrong. I'm out. That's it. Take my loss. We kept the loss small on this trade with these 4 contracts. I believe our loss was a couple $100 with the potential to make 700-800. I mean, it was a good reward to risk ratio. That's one of the reasons we took the trade. Now, weekly versus monthly. Let's go back to that little discussion where we have a stop, we have a target, we have a time frame. Now, just based off of, let me actually undo this and I'll show you. I hope this is interesting. If not, you probably would just leave. So I guess it's that easy, right? You would just bail. I'm going to do the same thing. 295 by 285 bull put spread. Okay, there. In September. Let's talk about the difference. Now, let's focus on a couple of things, one point at a time, and then it'll help to illustrate the differences. If you were hoping I was going to tell you which one to pick, I can't. I'm going to tell you the pros and cons of each. Because I've already shown, as a seller, I like the benefit that theta will increase rapidly and I will get to expiration quickly, where I make all of my money as a seller. So I don't mind selling short term. As a buyer, I'm sometimes willing to speculatively, where I'm looking to swing on if I find a nice momentum trade where the volatility is low, I'm going to swing for the fences. Try to catch a 5-to-1, 6-to-1, 10-to-1 sometimes trade, right? Those are, that's a lot more rare, but I will do it. So there are circumstances where I will do both selling and buying for that. And then there are circumstances like this where it's like I have this credit spread where if I sell short term, time can decay in my favor faster. However, the other side of that coin is, what about my ability to contain the risk? I always want to make sure I have a good ability to contain the risk. So the evaluation was, let's look at, and I actually did, it's weeklies, but it's actually the monthly, right? This is the standard contracts. Why? You're always going to get better volume and open interest. I think that was actually a point I wanted to make. So let me make it. Let me go back real quickly here. So here is the standard. You can see I've got 14,000, 14,000, 7,000. On the puts, 7,000, 2,000. This is my open interest, huge amounts, right? If I went 10 days out, you can see 1,000, 2,000. I've got one place with 7. Over here, barely hit 1,000. So I'm always going to have larger amounts of open interest, which typically lead to slightly tighter spreads here at the monthlies. So I like the monthly weeklies more than I like the weeklies. I will trade the other ones, especially if I'm trading SPY, QQQ. There are some of the more widely traded stocks where you're not going to see much of a difference. Again, just something to look at, because the more efficient, the tighter the spread. And if I were to run some numbers for you, just think about if you trade 20 to 30 times a month and you can shave $10 of spread per contract, right? 10 cents. That's 10 cents only. It's thousands of dollars, thousands, tens of thousands a year, depending on how much you trade. It's scary when the numbers add up. Trade efficient markets. Please tell me, what is open interest and what is the optimum number of size? Thank you. Good question, pals. Open interest is how many contracts already exist. Now, we don't know for sure how those contracts started. When you start an option, so for example, when I did my contracts with 4 contracts here, I bought to open these 4 here. I sold to open these 4 here. So at the end of today, I added 4 more open interest to the 285 puts and 4 more interest to the 295 puts. That's open interest, right? When you buy to open, you add that to the open interest. When you sell to close, it would reduce that from the open interest. So open interest tells you how many contracts exist out there right now. Volume tells you how many traded today. And again, we don't know. Volume could be buy to open, could be sell to open, could be buy to close, could be sell to close. We still don't even know. Even the open interest might go up or down, but we don't know exactly who's buying, who's selling. So that that information is not out there. It would be very interesting if we did have that, but we don't. But that's what open interest is. Optimum number is as much as possible. Thousands is better than hundreds. Hundreds is minimum required, because if you don't have hundreds, you're going to have very wide spreads. That's what it'll boil down to. So now, even as I do these comparisons, I'm comparing the weeklies using a monthly option versus about 6 weeks out monthly options. So let's talk about first and foremost the advantages of the weekly option, and that's going to come here at theta. Remember, theta is time decay. If you're not comfortable with your Greeks, I would suggest you go into the archives of our active investor, and there is a Greeks presentation in there where a really smart instructor gives a presentation about option Greeks. You would love it. Go check it out. I know him. He's a nice guy. People say nice things about him. So what do I see here? This is my theta, 29. Okay. If I look at the options that I have, my theta is only 2. Oh, wait a second. That's off a little bit. I'm going to make this 4 contracts. Gotta compare apples to apples. Still 12, right? 12 versus 2. So someone might say, Scott, your theta is so slow. Why did you go out to October? It's a good question. That's fair. That's a fair question. Because this is not a time spread by definition, nor was my primary objective time decay, right? So that's whenever I think about a trade, I have a trading rule. This is kind of on topic. My trading rule says, if the original reason for getting in the trade is no longer valid, get out. If the original reason for getting in is no longer valid, get out. Okay, what's the original reason? Why did we get into Facebook? We got into Facebook because A, we're bullish. B, we thought it was finding support and bouncing off. Therefore, if it breaks support, we're wrong. That's why we put our stop loss below those old candles, right? If it breaks below those lows, it broke support. What else? We took a bull put spread. Why? Well, if you look at my implied volatility, it's not as high as it was back here, Corona crash. But if you notice, the volatility has definitely surged up to its highs here in the last 4 months. Down here at a 35 volatility, I'd look at buying options, right? Here with a 50 volatility, I'm going to say they're more expensive. I'm going to sell them. So because the implied volatility was high, I decided to sell a bull put spread. Very specific reasons in going into these trades. So if anything, if the volatility drops, that's going to help me, right? I'm Vega negative. Volatility drops, it helps me. If the as time ticks, it helps me. Only at $2, not $12. But the main reason I took the trade was price, because I think that it's going to make a move up here to 325. That's why I took the trade. That's the number one thing I'm trading. So the number one thing I'm trading here is delta, price action. So then the question is, how well does this contain my risk? So if you look at theta, it's smaller. If you look at theta, bigger, delta, bigger. And you might think, Scott, again, look what you've done. You slowed the delta from 54 to 32. Why would you do that, Scott? Okay, again, a valid question. Let me answer that question for you. Because delta is not a measure of quality. Neither is theta. Those aren't quality measures. They're just behavior measures. As time ticks, how much money do I make? As the stock goes up or down, how much money do I make? Or lose? That 54 goes against me if I'm wrong, right? So it's not just the upside, but the downside that I'm worried about. So if you look at what we did, you can see here with 4 contracts and these variables, we have $145 of risk for $1,000 of gain. Whereas here, we would have $166 of risk for $700 in gain. So again, now let's focus on just the reward to risk ratio. That's it, nothing else, just reward to risk, okay? So here is the box. These are pretty close, but this one is 20 higher. So let's just look at that, right? September, 2 contracts, 166 of risk. October, 4 contracts, 145 of risk. Same, slightly less. What is this risk getting me? 1,000, almost 1,100. What is this risk getting me? 722. Now, of course, as I stay in the trade, let's go a week out. It might improve here, right? Now, this gets a little better because the time decays still close to 160, $800. So that's improved. You thought, what? 5 grand? No. Still 150-ish. Now I'm getting close to $1,200 if it gets up to this one, right? Because I have a better ability to control my risk, I'm able to do more contracts, 4 contracts versus 2 contracts. Let's go another week. 140 risks still. If all of a sudden that trade just fell apart on me, versus if it does, now at this point, all it has to do is stay above. But this one's here, it's got to get to this target, whereas the other one doesn't. Okay, so this is where if you lasted this long, now here's the thing for me. I'm not going to last this long unless the trade is working, right? I mean, if I'm 2 weeks in, this stock better be going up. Otherwise, I'm going to have shut it down. But let's go through. So 142 risk for 1,200 gain versus 145. So they're about the same on risk now, but still almost $400 less here. But you are making more money in the middle, and you're very close to this thing getting to max gain now, right? So you would, whereas the other trade at this point still just kind of chugging along. So there are definitely advantages and disadvantages to using these types of strategies, but it's not always what you think. Sometimes, right, like in these, it was when I first started seeing that, I started improving some of my spread trading because I realized, right, when they first came out, the weeklies, I'm like, oh, I'm just going to sell a weekly spread every week. Boom, time decay in my favor. Time decay Monday, put it on Friday, it decays and expires. The problem is what happens when it goes against you? Now you have to play defense. And defense, the last week of a trade. So when you're trading weeklies and you're literally in the last week, there's this thing called gamma risk. So when you see me look at the Greeks for options trades, you see me look at the delta, you see me look at the theta and vega as the primary. So this is price right here. This is time. That's a clock, right? And this is volatility. So this is the choppiness, price, time, volatility. Gamma is kind of a secondary. It tells us how much this is going to change. For the most part, I don't pay any attention to it. However, when you get to the last week of a trade, you have to pay very close attention to it because gamma risk, when there's not a lot of time left, the trade can work for or against you very quickly, especially a spread, right? A spread could go from max gain to max loss overnight. I've seen it. I've worked with people who have seen it. I mean, it's really kind of a crazy thing, so you have to be careful. So for all intents and purposes, when I do this bull put spread that we did, not this one, my objective is not to stay in the trade until October. It's not. There are times, if I did the September option, I might be where my objective is to stay in because that gives me a higher probability of success. It doesn't have to be up around 335. It just has to be above 295 around that time. The October trade, it has to move. It is an absolute directional trade primarily. So that has to be working in order for me to stay in the trade. I just like to have time in my favor. So again, what's your objective? Time decay? You'd go with the weeklies. A better ability to manage risk? Go with the monthlies. Every circumstance has a little bit different potential. That's why it's so important that you are understanding these Greeks, these deltas and thetas and vegas help us. But remember, it's not about this delta is better than that one. It's about what is the totality of it and the final. So a lot of times people will ask me, and this is going to lead to a question that somebody asked that has gone unanswered, Ted, and I'm going to hit it now. A lot of people, when I start working with them one-on-one in coaching, will say, Scott, what's your favorite indicator? What's your favorite indicator? And I say, and I know what they mean, right? They mean, on a chart. Obviously, I like the Tradespoon tool. That's an indicator. I like Heikin-Ashi candles. That's an indicator. Candlesticks to me are not indicators; they're price action. So I do differentiate between the two. But my favorite indicator is not on a chart. My favorite indicator is reward to risk. That's the final indicator. For me, if I do all the work and I have this beautiful chart set up and then it says I'm getting 1.5 to 1, I'm a pass. I'll be like, no, not 1.5. I need 2 to 1 at least. Sometimes even 2.5 to 1 as a minimum. I'd like to get 3 to 1, but those are my minimums. Yeah. Someone asked a question, how can you tell the 5 to 1 trades versus smaller returns? Honestly, 5 to 1 is pretty rare. I mean, right now I'm not expecting to get any. For a 5 to 1 trade, you would need to have a stock that's got high momentum, right? Making pretty big moves. Your Teslas, your Squares, Docus, Zooms, right? Some of these that kind of make some big moves. Catch it on a pullback on a turn where you buy an option and they're relatively cheap. I mean, if you do a spread trade, I'm not going to get 5 to 1 on a spread. 3 to 1 at best, right? Is all I'm expecting. 3 to 1 on a spread is usually the best I'm going to get. To get a 5 to 1, 6 to 1 or better, you're going to have to buy fairly cheap out of the money options for a nice swing trade. Other than that, it's just not going to happen. That's a hard thing to catch. Now, for something longer term, you might, but are you longer term? Are you a longer term trader? Those would be your questions to ask. Support on TOS claims we cannot filter options by weekly only. For scanning, scan in weeklies. Boom. Right? Although this says 574. So I'm a little bit suspect of that now. That was the only way I knew how to do it, Ted, was to go scan in weeklies. It's a watch list in here, but I don't know how much that's managed, right? Let's see. So some of these applied optic electronics, there's no way that has weeklies, right? AAOI, that can't possibly. It does. Okay. It's actually got decent options here. Well, not really. Let's see. So this is showing me 50 at a time. So I don't know. That's interesting. I thought maybe there are more than we thought. But that right there is supposed to search in stocks that trade weeklies, and then you could intersect it with other things and then you could add different filters. That's what I meant when I said we can filter by weekly only. So I don't know. What do you think? Does that tell them they're wrong, or do you think I'm wrong that that's what it's doing? I don't know. I could be wrong. That's what it's supposed to do. Scan in weeklies. Um, and I guess the question would be, can you find something in here that doesn't actually trade weeklies? APT, what do you think? APT, it's got weeklies. It shouldn't. So here, I'm glad we did this. It has weeklies, but it shouldn't. I mean, here you can see several hundred. Oh, you got thousands here, but look at the spread. 152 by $1.80. I mean, these spreads are ridiculous. There's just nothing in there. You can buy these out of the money options, I guess. Even here, you can see this is the standard options, and it's got 157 contracts, 197. Options are all over the place. You pay $2 for this; it's worth 27 cents. When I mean, this is madness. It's anarchy, option anarchy. So yeah. Okay, what else? Questions? Weeklies, monthlies. Anything can be applied. Any strategy can be applied. You can buy them, you can sell them. When you start to do things like calendars, I think a lot of people go 1 month, 2 months, 1 month, 3 months. I like to go 2 weeks, 4 weeks, nice and short and sweet time decay. That's what we're looking for. Look for liquidity, first of all. But even here, you can see this proves my claim. Just because it has weeklies doesn't mean it's necessarily viable. You still have to do a little due diligence and make sure that it has. But imagine if it doesn't have weeklies, it doesn't have a great chance. Okay, final questions. What do we think? Winging it today. Weeklies versus monthlies. Understanding. There's no right or wrong. There's just different. Do you need time? Do you want time? Do you want it to linger? Do you want it to expire quickly? What are your concerns? As long as you have an idea of your price expectations, where are you right? Where are you wrong? Your time expectations, how long do you expect to be in the trade? And you have an idea of how you can manage the trade. You should be able to come in here and really build a fantastic trade where your risk is managed and controlled. You have a favorable reward to risk environment, and then you have a plan for how to manage that trade going forward. It's quiet today. There you go. Henry said it. Plan the trade, trade the plan, and stay safe. Thank you, Phil. I appreciate that. So there it is. We will be back in 2 weeks. And I don't know what the presentation will be, but we're going to wing it. I'd rather jump in here and show you live, right? Rather than show you slides that give you bullet points, I'd rather show you exactly why did I pick October instead of September, and what might have given me maybe an inclination to go the other way, and give you some real life trading examples that actually would illustrate that type of a decision matrix. Anyways, those of you who are in trading rooms, I will see you guys tomorrow. Those of you who are just kind of checking us out, keep checking us out. Eventually, pull the trigger, come in. Remember, you can always get 30 days free, and if it's not what you thought or what you were expecting, you can get your money back. If it is, right, we're a great trading value. Come in, get some trade ideas, etc., etc. Have a wonderful rest of your day. So those of you who are just perusing, I'll see you in 2 weeks. Those of you who are members and are in the trading room, I will see you tomorrow. As always, my friends, happy trading.